AI stocks got battered this week, and investors are wondering, what should I do? Is this the end of the boom, and are we slated for a huge crash? Well, fortunately, the markets are broadcasting an important sign that things aren't that bad. And for smart investors, there's still an opportunity to be had. So I will show you what I mean. I've got a short update this week because it'll only take a couple minutes to show you the most important thing happening in the market, and you'll walk away with a valuable tool to help you read the market and know what's going to happen next. So here is how we got here. Last week, I warned you that AI stocks risked a crash on slowing AI progress, and the crash started the very next day. AI and other technology stocks beat a retreat from their highs this week. Nvidia, Broadcom, Intel all took dips greater than 3%, and AI darling Palantir fell more than 12%. So the NASDAQ 100 overall took a quick tumble, and it's exactly as I warned. The market is driven by stories, and the narrative that AI progress has slowed is spreading. Even Sam Altman, CEO of OpenAI, admits that he thinks investors have gotten overexcited about AI. But look, 1 week does not make for a crash. Markets are noisy, and this isn't enough yet to make a trend. And to be clear, I never said AI wasn't real and wasn't going to happen. But the important thing is that the rate of progress has a big effect on financial markets, and that will determine if the infrastructure build-out for AI has gone too far. After all, we've seen that happen with new technology time and time again. So, just so far, watching this week, you don't have to fret just yet. And this right here is the big thing to watch. The market isn't crashing. Only AI and tech stocks are. While AI stocks struggled this week, the market didn't go into free fall. And stocks like Philip Morris International, Procter Gamble, Caterpillar, Costco, these all rose. So what you're seeing is consumer staples, real estate, and the much maligned healthcare sector all posted positive returns. And in another important sign, Walmart reported that consumers remain resilient. And that is huge. And I want to step back and talk about that for just a second, because don't forget that for the first time in a century, tariffs are back in a big way. They're reshaping the market. I just finished writing my trade war playbook, a concise guide to spotting the next big winners and protecting your portfolio in this new era. And right now, I'm giving it away 100% free. So click the link in this video description to sign up now and understand how tariffs work. But let me get back to what this week's action means for the market, because this is something you need to know. And this is what you call reading the market's internals. That means you don't just watch the headlines. You don't just watch the S&P 500. You need to watch the way different parts of the market are moving. And after doing that for 20 years like I have, you get a feel for who's doing what and why, and it helps you understand the story of the market. But you don't need 20 years experience to understand what's happening right now. And it's very simple. The market rotated from highly valued, risky AI stocks into more defensive sectors. Simple as that. Healthcare, consumer staples, these are the kinds of things that institutions and big investors turn to when they want to stay invested but get a little safer. Textbook market rotation. That matters, and it's a good thing. If investors started to worry about an AI slowdown and pulled all their money out of the market, that's a bad sign. The big crashes come when money comes out of the market, when liquidity dries up. But market rotation is different. It's healthier. It means investors want to own equities, just different ones. They want to rebalance their portfolios, not liquidate them. It's a measured, rational move rather than a panic, and that's a huge difference. And here's what's exciting. Given how much AI, the Magnificent Seven, and the biggest stocks have dominated returns, there are so many quality businesses out there trading at affordable prices. It would be extremely healthy for this market to rotate into sectors aside from large cap tech. That's the best way for this bull market to continue and dodge the ever-present threat of a crash. And that means there are good investments out there. Healthcare, small caps, international stocks, precious metals like gold, energy. These are the things I've been telling you about here at This Week in Wall Street. And there's so many opportunities for smart investors. We'll be covering them here at Stansberry Research, starting with that trade war playbook. You can get in the link below. But for now, here's what you need to watch going forward to diagnose whether we're facing an AI slowdown or a complete market crash. And specifically, there are three things. Number one, of course, is still AI. It's still important. Progress on developing intelligence and spending on data centers will drive this market, and you need to stay informed. But number two, you need to keep watching for this rotation. If AI continues to lag and other sectors rise, the market can stay resilient. But if AI falters, and so do the traditionally defensive plays, we could be in for a much bigger pullback. And the third thing to watch is something else entirely, but it will set the path of the stock market going forward, and that is interest rates. Lower rates tend to raise asset prices and send stocks higher. They could be the rocket fuel to keep this bull market going because, unfortunately, the Federal Reserve has become driven more by politics than economics. The Fed had a big meeting in Jackson Hole, Wyoming this week, and everyone was watching for signals on where rates were headed, but it really doesn't matter one bit because President Trump has made it clear that Jerome Powell is a lame duck Fed chair when Powell's term ends in May. He will not be reappointed, and it's inconceivable that Trump won't appoint a highly motivated dove to drive interest rates lower, even if inflation is a threat. So here's the point. Trump wants higher stock prices, and come May, he'll have a lot more power to drive them higher, at least for a while. That's not a good thing for the long term, but it can keep pushing this market. So look, at any time, the market presents risks and opportunities. AI is still a big driver, whether that's going to be up or down, and reading the rest of the market is the critical thing you need to watch. The best way to keep up on all of this is to join us completely free, Stansberry Research. Hit the link below, start with the free Trade War Playbook, and be sure to like and subscribe here on YouTube so you never miss an update. That's all for now, and I will be back next week.